Hi there, it's Friday the 14th of September 2018. I'm Steve Towers. Welcome to International Tax Bites, ITB, my weekly review of the important international tax developments impacting multinationals. This week I have these stories for you. Well, at last weekend's informal ECOFIN meeting in Vienna, some progress was made towards achieving a consensus on the EU's digital services tax. Many of the member countries are saying that an agreement by the end of 2018 is realistic. An important factor supporting the emerging consensus is the proposal from France that the introduction of the DST should include a sunset clause that is linked to global developments. This would mean that when there is an OECD level agreement on digital taxation, the OECD approach would replace the EU's DST. This cautious optimism doesn't mean that all of the details have been agreed. For example, the issue of whether the scope of the transactions covered by the DST should be reduced, for example, by excluding revenue from the sale of user data, is unresolved. Further technical discussions will occur during September, and then the finance ministers will consider this topic again at the next ECOFIN meeting on the 2nd of October. There seems to be 5 member countries which are the strongest opponents of the DST proposal: Denmark, Finland, Ireland, Malta and Sweden. After the meeting, Malta's finance minister stated that he doubted that an agreement could be reached by the end of this year. But some optimists have pointed out that the consensus on ATAD 1 and 2 emerged very quickly. We'll see. The OECD has published a tax working paper on simplified registration and collection mechanisms in the context of taxpayers which are not located in the tax jurisdiction. A tax working paper does not represent the official view of the OECD or its members. For a copy of this particular working paper, please go to our website or app. And at last week's IFA Congress in Seoul, an OECD official stated that the OECD is developing guidelines for the mandatory co-opting, my terminology, of digital marketplace platforms in regard to VAT collection. Such mandatory co-opting already exists in some countries. For example, the UK has introduced such rules, and a similar measure is expected to commence in Germany on the 1st of January 2019. The official said that the guidelines will be presented at the March 2019 meeting of the Global Forum on VAT in Melbourne. The OECD has released new transfer pricing country profiles for 7 countries: Costa Rica, Greece, South Korea, Panama, Seychelles, South Africa and Turkey. In addition, the existing profile for Singapore has been updated. There are now transfer pricing country profiles for 52 countries. If you'd like to see all of these profiles, please follow the link on our website or app. The OECD has released an updated version of its guidance on the implementation of CBC reporting. I've lost count of the number of editions of this guidance over the years. This could be number 7 or indeed number 8. The good news is that, as usual, the OECD has published a consolidated version of the guidance. The changes made in this latest edition include the treatment of dividends received and the number of employees to be reported in cases where a multinational uses proportional consolidation in preparing its consolidated financial statements. For a copy of the latest edition, please go to our website or app. The WCO, the World Customs Organization, has released a new edition of its Guide to Customs Valuation and Transfer Pricing, a very thorny issue. For your copy of this new edition, it's 114 pages. Please go to our website or app. And Baker McKenzie has released a report with an interesting name, The Shape of Water, Tax Disputes in the Age of Intangible Value. The report estimates that the total amount of tax in dispute amongst the Fortune 500 companies is as much as $75.3 billion US. For your copy of the report, please go to our website or app. I have 2 cases for you this week, both from India. The first case is Poddar Pigments, and it was decided by the Delhi Income Tax Appellate Tribunal. Poddar Pigments is an Indian resident company. It made payments to a German resident individual, a Dr. Tila, who is a scientist. The payments were for Dr. Tila's technical advice in regard to the development of new products by the Indian company. Such payments would definitely fall within the definitions of fees for technical services, FTS, under the Indian domestic tax law and under Article 12 of the India-Germany Treaty. Under Article 12.2, Indian tax may be levied, but it is limited to 10% of the gross amount of the FTS. But Article 12.2 is subject to Article 12.5, which says this: the provisions of Article 12.2 shall not apply if the beneficial owner of the FTS, being a resident of Germany, carries on business in India through a PE situated therein, or performs in India independent personal services from a fixed base situated therein, and the contract in respect of which the FTS are paid is effectively connected with such PE or fixed base. In such case, the provisions of Article 7 or Article 14, as the case may be, shall apply. Now, on the facts of this case, Dr. Tila did not have either a permanent establishment or a fixed base in India. So that would mean that Article 12.5 doesn't apply, and we'd be left with Article 12.2. India may tax, but with a limit of 10% on gross. But Poddar Pigments argued that Article 14 applies. Article 14 says this: 1. Income derived by an individual who is a resident of Germany from the performance of professional services or other independent activities of a similar character shall be taxable only in Germany, except in the following circumstances when such income may also be taxed in India. A. If he has a fixed base regularly available to him in India for the purpose of performing his activities, in that case, only so much of the income as is attributable to that fixed base may be taxed in India. Or B, if his stay in India is for a period or periods amounting to or exceeding in the aggregate 120 days in the relevant fiscal year. In that case, only so much of the income as is derived from his activities performed in India may be taxed in India. 2. The term professional services includes independent scientific activities. The tribunal accepted that Dr. Thiele's services fell within the definition of professional services in Article 14.2, and that his fees from Poddar Pigments were income derived from the performance of professional services, as mentioned at the start of Article 14.1. It was also accepted that he did not have a fixed base in India and he was not caught by the 120 days test. So therefore, Article 14.1 would say that Dr. Thiele shall be taxable only in Germany on the fees from Poddar Pigments. So therefore, we have a conflict between Article 12.2 and Article 14.1. Article 12.2 allows India to levy tax on Dr. Thiele's fees, up to a limit of 10% on gross. But Article 14.1 provides him with an exemption from Indian tax on his fees. Which provision should apply? Well, the tribunal started by saying that the more specific provision should prevail. It is also an established rule of the interpretation of treaties that specific or special provision in treaty shall prevail over and take precedence over the general ones. It then said that Article 14.1 is the more specific provision because it applies to professional services of individuals, whereas Article 12.2 applies to all types of taxpayer. And on that basis, the tribunal decided that the exemption under Article 14.1 should apply. I know what you're thinking. You're wondering whether the same conflict can arise under the 2017 UN Model Treaty, which includes both the new Article 12A on fees for technical services and Article 14 on professional services. The answer is no. Article 12A2 of the UN model includes the key words notwithstanding the provisions of Article 14. So in the UN model, Article 12A2 prevails over Article 14. That same situation is achieved with Article 7, the business profits article, by virtue of Article 7.6, which allows other provisions to apply unaffected by Article 7. And just to complete the story, Article 12A4 will transfer the matter to Article 7 or Article 14 if the fees are effectively connected with a PE in the source country, that's Article 7, or with a fixed base in the source country, that's Article 14, or with the same or similar kind business activities in the source country, that's Article 7 also. This case was decided by the Madras High Court. The taxpayer, TVS Motor Company, is an Indian resident company. It entered into a contract with the University of Warwick, a UK resident institution, for the provision of technical services by the university. It was accepted that the service fees fell within the definition of fees for technical services, FTS, in both the Indian domestic tax law and the India-UK double tax treaty. The issue in the case concerns the calculation of the limitation on Indian tax under the treaty. Under Article 13.2 of the treaty, the Indian tax on the FTS shall not exceed 15% of the gross amount of such FTS. I'll come back to Article 13 in a moment. But first, let's look at the contract between TVS Motor Company and the university. Clause 10 of the contract says this: the parties have agreed that TVS Motor Company will pay the university a fee of $200,000 net of Indian taxes. Indian income tax, if any, will be borne by TVS Motor Company. So, as you can see, the payment obligation is in the net of taxes form. TVS Motor Company must pay $200,000 to the university, and it must bear the Indian income tax, if any, in regard to that payment. The net of taxes form is one way for contracts to assign the tax liability to the payer. A more common way of doing so is the express gross-up clause, which might say something like this: any amount which is stated to be payable under this contract shall be increased to such amount as would, after deduction of withholding tax, be equal to the amount stated to be payable under this contract. TVS Motor Company argued in this case that the Indian tax limitation under Article 13 should be calculated without a gross-up. Let's go through the numbers. Under Clause 10 of the contract, TVS Motor Company must pay $200,000 net of Indian taxes to the university. This $200,000 is the amount of the FTS, and it must bear the Indian tax, if any, in regard to that payment. Under Article 13.2 of the treaty, Indian tax is limited to 15% of the FTS. So, according to TVS Motor Company, 15% of $200,000 is $30,000. It therefore paid $200,000 to the university and $30,000 to the Indian tax authorities. The Indian tax authorities said, no, you must gross up the $200,000. The grossed up amount would be $235,294. 15% of $235,294 is $35,294. So that would mean that $200,000 would be paid to the university and $35,294 would be required to be paid to the tax authorities. TVS Motor Company put forward an interesting argument based on the drafting of Article 13 of the treaty. Article 13 relevantly says this: 1. FTS arising in India and paid to a resident of the UK may be taxed in the UK. 2. However, such FTS may also be taxed in India and according to the law of India. But if the beneficial owner of the FTS is a resident of the UK, the tax so charged shall not exceed 15% of the gross amount of such FTS. This provision is structured in a familiar way. It's like Articles 10 and 11 of the OECD Model Treaty prior to the 2014 update, and it's also like Articles 10, 11 and 12 of the UN Model Treaty. I'm referring to the two-paragraph structure together with the phrase such FTS. Paragraph 1 refers to FTS arising in India and paid to a resident of the UK. Note the reference to FTS paid to a resident of the UK. Paragraph 1 says that such FTS may be taxed in the resident's country, the UK. Paragraph 1 is very important because it sets the scope of paragraph 2. Paragraph 2 starts with, however, such FTS. That's a reference to the FTS which is described in paragraph 1, which includes the requirement that the FTS is paid to a resident of the UK. And so TVS Motor Company argued that when paragraph 2 states the tax limitation as being 15% of the gross amount of such FTS, the FTS which is being described is the FTS which is described in paragraph 1, and that FTS must be paid to a resident of the UK. The amount paid to a resident of the UK, according to this argument, is $200,000. Therefore, the limitation in paragraph 2 is 15% of $200,000, which is $30,000. However, the court decided in favour of the tax authorities. It identified the fact that the phrase gross amount in paragraph 2 is not defined in the treaty. Therefore, it said that it would be appropriate to see if that phrase has a meaning under Indian domestic tax law, which it does. I should note in passing that this appears to be an application of Article 3.2 in regard to the meaning of undefined terms, but that provision was not expressly referred to in the decision. The Indian domestic law meaning is provided in section 195A, which applies to income which is payable net of tax. It directs that a gross-up calculation should be undertaken. So as soon as the court decided that it should consult the domestic law meaning, the tax authorities had effectively won. But let me make some general comments in regard to tax gross-ups, or to use a more neutral term, withholding tax indemnities. The method of calculation of the withholding tax is dependent on a fundamental question, which is this: does the withholding tax indemnity amount take the same character as the underlying amount? In other words, if the underlying amount satisfies the definition of FTS or interest or royalties, would the withholding tax indemnity amount also satisfy that definition? That question of characterization is relevant from both a withholding tax perspective. Is the withholding tax indemnity amount itself subject to withholding tax? And a tax deductibility perspective. Does the character of the withholding tax indemnity amount have an impact, positive or negative, on the tax deductibility of that amount for the payer? For example, there is Australian case law which says that in the case of interest, the withholding tax indemnity amount does not take the same character as the underlying amount. It's also important to remember that in this TVS Motor Company case, there was a net of tax clause, not an express gross-up clause. With an express gross-up clause, it might be easier to conclude that the gross-up amount takes the same character as the underlying amount. But the net of tax clause does not expressly say that the FTS is increased by the amount of tax. It merely says that the payer will pay the tax. Does that make a difference? Or should they both be treated in the same way? And now for the developments in Asia Pacific. In Cambodia, the tax authorities have released an instruction which requires that arm's length interest be charged on loans between related parties. This is a change from the previous policy. Under an instruction issued in 2014, related party loans were permitted to be interest-free, provided the loan agreement was supplied to the tax authorities within 30 days. In China, the government has responded to the threatened further increase in US tariffs by increasing the VAT refund rate on 397 types of goods, effective the 15th of September. In line with most VAT systems, China's goods exports are VAT zero rated. However, unusually, China imposes a limitation for most types of goods on the amount of VAT input tax credit which can be refunded on export. The limitation varies between types of goods. By increasing those limitations, the government ensures that the Chinese tax cost on exporters is reduced. The 397 types of goods cover a wide range, from multi-component integrated circuits, basalt fibre and safety pins, to books, newspapers, bamboo carvings and wood fans. Well, something unusual has happened in regard to China's tax policy. There's been an abrupt U-turn in response to public criticism, including by the People's Daily, a government-controlled newspaper. I'm talking about a preferential 20% income tax rate which has been applied in some regions to venture capitalists, instead of the technically correct progressive rate scale from 0 to 35%. A senior SAT official started the dispute by describing the 20% rate as illegal and said that the progressive rate scale will be imposed on venture capitalists retrospectively. The People's Daily called this a disaster and said that venture capitalists were in turmoil. Well, the government then quickly announced that the income tax law will be amended to ensure that the overall tax burden on venture capitalists does not increase. In Malaysia, the rollout of the new SST has been a little bumpy, some commentators have said. If you want to access the very latest information and guidance from the tax authorities on SST, you should go to the MySST page on the RMCD website. You can find the link on our website and app. And now for the developments in Europe. Let's start with the EU. The EU member countries are in the process of drafting and enacting legislation which will implement significant parts of the EU's ATAD1 directive and the 2017 VAT directive. For example, in the last couple of weeks, Bulgaria and the UK have published for public comment draft bills which will allow compliance with their obligations under one or both of these directives. The approaching deadline for implementation is the 31st of December 2018. At last weekend's informal ECOFIN meeting, Germany revived the idea of minimum effective taxation to protect against base erosion involving interest and royalty payments to low-tax jurisdictions, both within and outside the EU. This idea has been considered from time to time since 2015. So far, there hasn't been an EU consensus for such a rule. Well, it's now going global. The French finance minister said that he will take up the issue when France holds the G7 presidency next year. And speaking of reviving ideas, this week European Commission President Juncker stated that the Commission will propose in January or February 2019 to replace the unanimity rule on tax matters with QMV, qualified majority voting. This will be interesting to watch. In Denmark, Parliament has passed legislation which makes a number of international tax amendments, particularly in regard to ensuring that the Danish tax rules comply with the EU's freedom of establishment and free movement of capital. There are three changes which I will note. Firstly, the thin cap rules will be amended in reaction to the European Court of Justice decision in the Masco case. This will mean that interest which is non-deductible in another EU or EEA member country under that country's thin cap rules will be treated as exempt from Danish tax in the hands of the Danish resident shareholder, subject to conditions. This change applies from the 1st of July 2018. However, commentators have suggested that the tax authorities will make it possible for the change to apply for earlier years. Secondly, the double taxation of a Danish permitted establishment in respect of dividends received from Danish companies will be removed. Under the change, the Danish dividend withholding tax will be creditable against the PE's Danish corporate income tax liability. This change is effective from the 2015 year. And the third change concerns the Danish taxation of non-resident pension funds, which are resident in an EU or EEA member country, in regard to direct investments in Danish real estate. The tax rate is reduced from 22% to 15.3%, and taxation will be on a mark-to-market basis instead of the realisation basis, subject to conditions. That tax treatment will then equate to the tax position of Danish resident pension funds with the same investments. This change is effective the 1st of July 2018, but tax returns for the 2015 and later years can be reopened to apply this change. The European Court of Justice has decided another VAT case concerning Romania's rules for declaring certain non-compliant taxpayers as inactive. You might recall the SC Paper Consult case, which was decided by the court in 2017. This present case is called Siemens Gamesa Renewable Energy. For a period of 6 months, the taxpayer was declared to be an inactive taxpayer because it had failed to file tax returns on a timely basis. During those 6 months, the taxpayer's tax identification number was therefore deactivated. Also, during those 6 months, the taxpayer incurred VAT on purchases. Despite the fact that the taxpayer's status and tax identification number were subsequently reactivated, the Romanian tax authorities refused to allow it to claim input tax credits for those purchases because the transactions occurred while the taxpayer was declared inactive. Consistent with its approach in the SC Paper Consult case, the court declared that the denial of input tax credits in this situation breaches the EU VAT directive. For a copy of this decision, please go to our website or app. And now to Greece, where the government has announced some tax rate reductions. There will be a gradual reduction in the corporate income tax rate from 29% to 25% within 4 years. And there will be a reduction in 2 VAT rates. The standard VAT rate will drop from 24% to 22%, and the reduced VAT rate will drop from 13% to 12%, both effective the 1st of January 2021. In Ireland, the government has published a feedback statement in regard to the implementation of CFC rules pursuant to ATAD 1. This paper is in response to the views expressed on the design of the proposed CFC rules in a public consultation exercise which concluded earlier this year. For a copy of the feedback statement, it's only 18 pages. Please go to our website or app. In the Netherlands, the government is proposing to amend the regulation which governs the tax relationship between the European part of the Kingdom of the Netherlands and the BES Islands in the Caribbean. The objective of the amendment is to avoid the double non-taxation situation which can currently arise if a company is formed in the Bes Islands but it does not request a residency certificate there. For a copy of the proposed amendment, please go to our website or app. In Poland, the 2014 decision of the European Court of Justice in the Skandia case has recently been applied by the Polish Administrative Court. You might remember that the Skandia case concerned a notional transaction between the US head office and the Swedish branch of a US company. Ordinarily, such an intra-entity notional transaction would be disregarded for VAT purposes. However, because the Swedish branch was a member of a Swedish VAT group, which was deemed to be a separate taxpayer, the transaction between the US head office and the Swedish branch was required to be recognised for Swedish VAT purposes. The facts in the Polish case were materially the same as those in the Skandia case, and thus the Polish court applied the ECJ's decision. And Portugal has become the latest EU member country to announce the introduction of live VAT invoice reporting, which requires that sales invoice details be electronically submitted to the tax authorities at the same time as being issued to customers. The new system will be effective the 1st of January 2019, and it will initially apply only to B2G, business to government transactions. Other EU member countries which have introduced or have announced the introduction of live VAT invoice reporting include Italy, Greece, and Hungary. And now for the developments in Africa. Well, there's been another twist in the story concerning Kenya's imposition of 16% VAT on petroleum products. As I mentioned in ITB last week, the VAT exemption for petroleum products expired on the 31st of August. A few days earlier, Parliament passed a bill to extend the exemption for a further 2 years. That bill needs the President's approval to become law. The next day, the 1st of September, VAT started to be imposed on petroleum products. That caused a large amount of public outcry. Late last week, a court issued an order for the temporary suspension of the VAT on petroleum products. Well, the latest development is that yesterday the President rejected the bill which had been passed by Parliament. The Speaker has called for a special sitting of Parliament next week. In Rwanda, the tax authorities have issued guidance in regard to the new rule on deemed payment of payables and accruals. Under the new rule, which was included in legislation enacted in April this year, tax-deductible payables and accruals, which have not been paid after 6 months, will be deemed to be paid, which would then commonly trigger a withholding tax liability. The guidance clarifies that the 6 months period refers to the 6 months immediately after the end of the tax period, which is the 12 months ending on the 31st of December. Therefore, if there are tax-deductible payables and accruals included in the accounting records for the year ending the 31st of December 2018, and if those payables and accruals have not been actually paid by the 30th of June 2019, they will be deemed to be paid on that date. Any resulting withholding tax will be due on the 15th of July 2019. And now to the Middle East and Central Asia. In Israel, the tax authorities have issued 2 circulars in regard to certain transfer pricing aspects of distribution, sales and marketing activities, and low-value adding intragroup services. The first circular, number 11, focuses on the distinction between full-fledged distribution, limited risk distribution, and marketing activities, and the appropriate transfer pricing method to use in each of these situations. The second circular, number 12, is focused on safe harbours. Compliance with a safe harbour means that a full economic analysis is not required to be submitted to the tax authorities. For low-risk distributors with no significant marketing intangibles, a net operating margin of 3 to 4% of sales would qualify for the safe harbour. For companies which provide marketing and advertising support services, a net operating margin representing a full cost markup of 10 to 12% would qualify for the safe harbour. And for low value adding intragroup services, the model identified in the 2017 OECD transfer pricing guidelines is generally adopted, with a markup of 5%. For a copy of the 2 circulars, please go to our website or app. In the UAE, the tax authorities have released guidance in regard to the issuing and content of VAT invoices. For a copy of this guidance, please go to our website or app. And now to the Americas. In Canada, the tax court has decided a case which concerns the regulated foreign bank exemption under Canada's CFC rules. The case is called Loblaw Financial Holdings. The relevant CFC was a subsidiary incorporated in Barbados. Although the subsidiary was indeed a regulated foreign bank with the required number of employees, the court held that it failed the further condition that it principally conduct business with arm's-length persons. In forming that view, the judge considered both sides of the bank's business, the receipt of funds and the investment of funds. The court therefore held that the subsidiary failed the regulated foreign bank exemption and thus the CFC rules applied. If you would like to obtain a copy of this decision, you can do so at our website or app. In the US, the big news is that the proposed regulations in regard to GILTI, Global Intangible Low-Taxed Income, were released by the Treasury Department yesterday. But don't get too excited. There are some major issues which have not been covered. In particular, these proposed regs don't cover the foreign tax credit, including the allocation of expenses, and the Section 250 deduction, which is relevant to both GILTI and FDII. These additional topics will be covered in separate regs. According to a senior Treasury official, the foreign tax credit guidance is expected in 60 days from now, and the Section 250 guidance will be released later this year. For a copy of this first tranche of proposed regs, please go to our website or app. Also in the US, Congress is considering the Tax Reform 2.0 package, which was presented by House Ways and Means Committee Chairman Kevin Brady this week. All of the proposals in the package focus on individuals and small businesses. And the IRS has released a draft of Form 8991, which will be used for the BEAT tax, the base erosion and anti-abuse tax. For a copy of this draft form, please go to our website or app. And now for this week's treaty developments. We've had 2 treaties signed and 1 treaty enter into force. Well, that's the way it is this Friday, the 14th of September 2018. I'm Steve Towers. Have a great weekend. So, the shape of water. I like water in the shape of a whiskey glass.